Today we're going to cover the condo loans, one of the most misunderstood loan types in our industry. Whether you are new or experienced, this training will sharpen your game. We're going to cover how to identify a condo versus non-condo, warrantable versus non-warrantable, the project approval process, reserve requirement, and the major Fannie Mae guideline changes coming August 2026. We'll also cover how to use all of this to win more referral businesses. So let's dive into it. The condo clients fall into three buckets. First-time home buyers, attracted to condos for the lower price point. They have no idea the HOA's financial health affects their loan approval. They just love the unit. Your job is to protect them before they're in too deep. So let's talk about buyers who's moving up or downsizing. When they're selling their house, they're buying a condo. Most common mistake loan officers make here is treating it like a regular purchase loan. It is not. The project has to qualify and not just to the borrower. Existing condo owners refinancing as well. Just because they already have a condo loan doesn't mean the project qualifies again. HOA conditions change. Project approval must be re-verified at every refi. So know the condo rules before your borrower falls in love with the unit. Prevention beats damage control every time. Here's the most important thing on this slide. It's not about the building style, it's about the legal form of ownership. A condo means you own the airspace inside the unit. Walls, floor, ceiling, that's yours. Everything outside, hallways, parking, pool, gym, is jointly owned by all unit owners through the HOA. The HOA collects dues, maintains the building, and carries master insurance. So, how do you confirm it's a condo? Pull the deed. If the legal description says condominium unit, it's a condo, and you need project approval. Now, the common lookalikes that trip loan officers up. Number one, the PUD. Looks like a condo complex, but you own the land and structure. No project approval needed. Treat it like a single-family home. 2. Detached condo. Standalone buildings. Looks like a house, but it's legally a condo. Project approval still required. Don't let the building style fool you. And number 3, Contel. Unit in a hotel with a rental program. Not eligible for conventional financing. Many loan officers miss this one. And co-op. You own shares in a corporation, not real property. Treat them separately. Very limited to Fannie Mae guidelines, and when you are in doubt, pull the deed. Let's spend a minute on the condo versus PUD comparison because this is the mistake that changes your entire loan process. They can look identical, same complex, same HOA, same amenities, but the legal structure is completely different. Key difference on this table is in a condo, you own the airspace only. Project approval is always required. HOA master insurance is required by Fannie Mae. In a PUD, you own a lot and structure. No project approval needed. Treated like an SFR. Master insurance not required by Fannie Mae. So how do you tell them apart? For condo, the deed or CC&Rs will always use the word condominium. For PUD, the title will show lot ownership. No condominium language anywhere in the legal docs. Also, desktop underwriter will classify it. Pay attention to what DU tells you. So pro tip, when in doubt, pull the deed. If it says condominium unit, you need project approval. No exceptions. Warrantable means Fannie Mae and Freddie Mac will buy your loan. Standard rate, standard process. Non-warrantable means they won't. Portfolio lender only, high rate, and harder to sell. To be warrantable, the project needs to check all these boxes. HOA in good financial standing. No single entity owns more than 10% of the units, 25% for new project, and at least 51% owner occupied. no active HOA litigation, no critical repair orders. HOA budget meets reserve requirements, and it cannot be a condo tail. Non-warrantable red flags. Single investor at 10% or more, rentals exceeding 35%, active litigation, critical repairs, new construction under 90% pre-sale. And condo tail characteristics, severely underfunded reserves. If you don't check these boxes before taking an application, you would be 3 weeks into the transaction when it dies. The buyer is devastated and the realtors will never call you again. Check the warrantability first on every single time. So every condo loan needs project approval. There are 3 ways to get there. Path 1 is the waiver of project review. 10 units or fewer. This is a new threshold. It used to be 4. Verify the project isn't unavailable in the CPM. Confirm insurance requirement, confirm no critical repairs for 5 to 10 units projects cannot be part of a master association. Path 2, full review, lender delegated. This is the most common path. Any established project, 11 or more units, and all new or converted projects. You collect the HOA docs, run the warrantability checklist, submit through CPM, and checkpoint after August 3rd of 2026. Full review is the only option for established condos. Limited review is gone. If you have files in process under limited review that won't close by August 3rd, convert to full review now. Path 3, PERS, Fannie Mae Direct Review. Exception only, high-rise to new constructions, complex situations leading into these situations. The requirement is now retired. For full review, you need 6 documents. The rule is simple. Collect all of them at application, not at underwriting. Every day you wait is a day you can lose the deal. 1. HOA annual budget. Current year, is the reserve allocation at least 10% of the total income? That's today's minimum. 15% starting January 2027. Start checking against that now. 2. Reserve study. Within the last 3 years, what's the funding level? Baseline funding method is now banned. Must use the highest recommended allocation. 3. Meeting minutes. Last 2 years. Look at the special assessment, litigation mentions, deferred maintenance discussions. These are your early warning signals. 4. CCNRs and bylaws. Confirms legal structure, maintenance, responsibilities, and confirms it's not a condo tail. 5. Master insurance certificate. The carrier, coverage amount, policy, period. Coverage must equal 100% of the estimated replacement cost. And lastly, 6. Current HOA statement. Dues amount, outstanding balances, and delinquency rate. High delinquency is a red flag for project eligibility. Build these 6 into your condo intake checklist on day 1 on every single deal. Reserve requirements are simplified. Reserves are the HOA savings account for future repairs. Roof replacement, elevator, structural work, all covered by reserves. An HOA without adequate reserve is living paycheck to paycheck. When something breaks, they hit every unit owner with a special assessment. That shock can push homeowners into default. Fannie Mae confirmed the link. Underfunded reserves and critical repairs go together. They are requiring more. Today's minimum is a 10% of annual budget. Income goes into reserves. On January 2027, that goes up to 15%. So this is a real example. $400,000 of HOA budget, $40,000 are required today. $60,000 are required in 2027. A lot of HOAs aren't there yet. How to read the budget is to find total assessment income, find the reserve line item, and divide. That's your percentage. Red flags are no reserve line at all. Reserve line is 0 or TBD, long list of deferred maintenances. If the budget doesn't qualify, get a reserve study. Must use the highest recommended amount. Baseline method is completely banned. Start checking every HOA budget against 15% now. So don't wait until 2027. So Fannie Mae issued the lender letter on March 2026. 6 key changes are now applied. 1. Waiver expanded to 10 units, effective immediately, which used to be a 4 units, less paperwork for the small deals. And 2. PERS are retired in Florida state. This also is effective immediately. Florida's new condo projects now use standard lender full review. No more PERS submission. Number 3. Investor concentration limit is gone, effective immediately. 50% of the investor cap is removed for established projects under full review. Note, the 50% of pre-sale rule for new projects still applies. 4. Limited review retired on August 3rd of 2026. This is the biggest one. It is gone and mandatory. No exceptions are applied. All established condos go full review or waiver only. So when you look into this, if you have files in the limited review that won't close by August 3rd, act now. 5. Reserve studies tightened. On August 3rd, highest recommendations are allocated and baseline method are banned. And 6. Reserve minimum to 15% on January of 2027. Full review applications are applied and start checking HOA budgets now. There are 4 months to August 3rd. The time is running. Here is where this training becomes business development tool. Most listing agents don't know these rules. The loan officer who educates them becomes their go-to referral partner. Help the agent to get HOA docs at listing, budget, reserve study, master insurance before the first showing, not after the buyer is under contract. If there is a problem and issues, better to know it before anyone falls in love with that unit. Share the red flag checklist. Is reserve allocation at least 10%? Are pending special assessment, active litigation, critical repair notices? If yes to any of these, the buyer's loan may not close. Agents need to know this upfront. Give them a competitive edge. Agents who present condo-ready listings, clean financials, current reserve study, with no red flags, will close faster with fewer fallouts. You can help them be that agent. That's your value proposition. Tell them limited review will be gone. After August 3rd, deals that used to close in 30 days or under, limited review will take longer or may not qualify at all. Agents need to set realistic timelines with sellers now. The agent who loses a deal at underwriting because of an HOA issue will remember who warned them and who didn't. So this is a field guideline. Before every condo application, apply these 6 steps. 5 minutes now will save 3 weeks later. Step 1. Confirm it's a condominium. Pull the deed, condominium unit in the legal description, and if it's condo, say lot, probably it's a PUD. Treat them differently. Step 2. Check the CPM. Log into Condo Project Manager and run it. When it shows not unavailable or ineligible, stop the transaction immediately. Step 3. Collect HOA docs, all 6, at application. Budget, reserve study, insurances, and minutes. Step 4. Warrantability check. Owner occupied at least 51%. Single entity under 10%. No active litigation. No critical repairs. No condotel characteristics. Step 5. Verify reserve funding. At least 10% today, heading to 15 in 2027. No baseline method. If using reserve study, highest allocation amount. Step 6. Choose the right review path. 10 units or fewer, waiver. 11 plus, established. Full review, mandatory after August 3rd. New or converted, full review. So I want you to memorize this and put it next to your computer and run it on every condo deal. So why the condo market matters now? About 20% of the home sales are condominium and townhomes, especially in California, where we operate. That percentage is even higher. After the Surfside collapse in 2021, Fannie Mae started directly connecting HOA reserve funding to structural safety. The data was clear. Underfunded reserves and deferred maintenance go together. The lender letter 2026-03 is a result of that. Here is the opportunity for you. Most LOs don't understand these rules. The ones who do will close deals that the others can't. Listing agents who lose deals at underwriting because of HOA issues, there will be more after August 3rd. These will shift to the loan officer who caught these problems early. Knowing the condo guidelines isn't just compliance, it's a competitive advantage. So I want all of us to apply these 4 action plans. Do them this week. First, know your condo versus PUD. On your next deal, pull the deed, confirm the property type before you take the application. Make it a reflex. Second, build your HOA checklist. Right now, add these to your intake form. HOA budget, reserve study, master insurance, meeting minutes. Collect all 4 at application on every condo on every single time. Third, audit your pipeline today. Any condominium purchases or refinances in the progress, any condo in process under limited review, check the closing date. If it's after August 3rd, convert to full review now. Fourth, educate one realtor this week. Send a quick message and tell them about HOA docs at listing. Tell them limited review is gone. Be the person who brings value before they even ask. The loan officer who understands condo loans will win more business. You now have the foundation. Thank you for watching, and I'll see you in the next one.